In the late 1600s, New York was a small colonial town, nothing like the towering financial capital we know today. The population was tiny, the streets were narrow, and one street in particular had a very unusual feature: a wall. The wall had been built by Dutch settlers to protect the colony from potential attacks. The street beside it eventually became known as Wall Street. At the time, no one could have imagined that this quiet street would one day control trillions of dollars and influence the global economy. But the transformation had already begun. In the late 18th century, traders started gathering under a large buttonwood tree on Wall Street. They bought and sold government bonds and company shares. At first, the market was informal. Deals were made face-to-face. Prices were negotiated in conversation. But in 1792, something important happened. 24 traders signed an agreement. It was called the Buttonwood Agreement. The agreement created rules for trading securities, and it laid the foundation for what would eventually become the New York Stock Exchange. For the first time, financial trading on Wall Street had structure. At first, the market remained small. But as the United States began industrializing in the 19th century, something powerful happened. Railroads expanded across the country, factories grew, steel production exploded, and companies needed enormous amounts of capital to fund that growth. Wall Street became the place where that capital could be raised. Investors purchased shares, companies gained funding, and financial markets began linking investors with industry. This process transformed Wall Street from a local trading hub into a national financial center. But the real shift came in the early 20th century. As American corporations grew larger, the financial sector became more influential. Banks, investment firms, and stock exchanges started shaping how capital moved through the economy. Wall Street no longer just supported businesses. It began influencing them, and sometimes controlling them. But financial power also came with risk. In the 1920s, speculation on Wall Street reached extreme levels. Stock prices rose rapidly. Millions of Americans began investing in the market. Many borrowed money to buy stocks, believing prices would continue rising forever. But in October 1929, that confidence collapsed. The stock market crashed. Prices fell dramatically. Investors lost fortunes almost overnight, and the crash triggered the Great Depression, one of the worst economic crises in history. The disaster forced governments to rethink financial regulation. New laws were introduced. Oversight increased. Markets were monitored more closely. For several decades, financial markets operated under stricter rules. But beginning in the late 20th century, another transformation began. Financial innovation accelerated. Investment banks grew more powerful. New financial products appeared: derivatives, complex securities, global trading networks. Wall Street was no longer just financing businesses. It was creating financial instruments that could move billions of dollars in seconds. By the early 21st century, the influence of Wall Street had become enormous. Financial markets affected everything: housing prices, corporate strategy, government policy, global investment flows. When financial markets rise or fall, entire economies can feel the impact. And yet, the origins of this immense financial system can still be traced back to a single street. A street that began as a defensive wall in a small colonial town. Today, Wall Street represents more than just a location. It represents the heart of the modern financial system, a place where capital moves, decisions are made, and economic power concentrates. Which raises an interesting question. If Wall Street has grown so powerful, how much influence should financial markets have over the rest of the economy?